What's going on, guys? Matty Ice here. Welcome back to another episode of Investing with Matty Ice, where I share my investing journey with you guys, specifically when it comes to income ETFs. And today, I am very excited to share my very first dividend with you guys from Stretch, ticker symbol STRC, for $235.23, I believe it was. Woohoo! Pretty excited. I'll throw it up on the screen for you guys to see. But what I want to do in this video is talk about what I plan on doing with it and why. Because the math would say that the best thing to do would be to invest that dividend into BTCI. It's my favorite income ETF right now. I talk about it all the time. All right, but here's the thing. This is something that I learned from a mentor of mine a long time ago. Is that life doesn't happen on a spreadsheet, meaning that there's more to life than just numbers, right? Than just the math. There's other things that we need to consider, and there's some very specific reasons why I'm not reinvesting the dividend into Stretch or BTCI, and I'm using it to pay down the loan that I took out to purchase more BTCI, which I did an entire video on, guys, breaking down the numbers, the strategy, the type of loan that I used. I highly recommend you check that out. I will link that down in the description below. But yeah, let's get into it. First, I want to talk about why I'm not reinvesting it back into Stretch. And also, as a side note, I should mention too that this dividend is actually pretty low because I wasn't able to deploy all of the capital that I had allocated for Stretch in time, like before the ex-dividend date or the record date, whatever, because the funds had not been made available in my brokerage account yet. That is available now, though, and I'll be deploying that this month. So the dividend next month should probably be between like $550 and maybe $575, which is freaking amazing. So stay tuned for that. But anyways, here's why I'm not reinvesting it in Stretch, because it's not going to really move the needle in my life significantly in the short term. Like assuming the $100 par value of Stretch, $235 is only going to get me like an initial 2 to 3 shares or whatnot, which is not going to increase the cash flow very much month over month. Now, here's the thing. If you're compounding it over 10, 20, 30 years, then absolutely this can really start to add up over the long run. Between 11 and 11.5% dividends, tax deferred, compounded over 10, 20, 30 years can be significant. Okay, that's huge. However, that's not what I'm using Stretch for. My compounding asset is BTCI. That's where I'm focusing the compound effect on. Not to mention, I'm compounding in 2 places at once right now because of the type of loan that I took. I talk about that in that video that I mentioned. But anyways, for me, Stretch is short to medium term capital storage, where I have, so it's going to be a total of $60,000 that I'll have in Stretch. Right, I have that's earmarked for certain future financial obligations later on down the road. So at some point, I'm likely going to liquidate my STR positions as those future financial obligations come due. Right, so for me, this is a shorter term play. Therefore, I'm more focused on the shorter to medium term when it comes to Stretch. Now, it's completely different with BTCI. That's a much longer term play. Right, but again, I guess that would transition to the question, well, then why not reinvest it into BTCI? Well, let's talk about it. So here's some very specific reasons. And it all has to really do with, it's really a psychological thing. It's not that I can't reinvest the dividends and use my own personal cash flow to pay down the debt. I could absolutely do that. And I might start doing that later on down the road. All right, but here's some specific reasons why. Number one, I've been pretty aggressively accumulating BTCI over the past few months, particularly like I started in my Roth IRA. And so I went through, I invested quite a bit of my original capital base. And so I'm focused on restoring that capital base, and that comes from my personal cash flow. And the loan amount, the payment amount that I determined for this particular loan, because I'm in complete control of how the loan gets repaid, guys, because just real quick, in case, for those of you that haven't watched the other video, I basically borrowed against my cash value whole life insurance policy. And so that's compounding at the same time, even while I have the loan outstanding. But because I borrowed against my cash value, I'm in control of how it gets repaid. So I decided to amortize the loan over 10 years, and it's at a 5.5% interest rate, which is ridiculous. And that translates to $542 a month. Well, That's $542 a month out of my personal cash flow that I could use to restore my capital base to take advantage of more opportunities later on down the road. Now, with that said, every time I make a repayment on this policy loan, that is immediately available to borrow against. Again, it's very similar to a line of credit. So, some of this is kind of like semantics or whatnot. But again, it's still just from a psychological standpoint, restoring that capital base is just what I'm focused on right now. Not to mention that, guys, it's really cool to have an asset, the cash flow from an asset paying for the loan service that you use to acquire another asset. It's kind of like if you had a rental real estate portfolio, and you took out, let's say you have 5 or 10 properties or whatever, and you're getting another property, and the cash flow from your portfolio is paying for the debt service on the new property, even though technically the tenant would. But you see what I'm saying? Like having the cash flow from these different assets pay for the debt service to acquire more assets, psychologically, that is just it's really, really powerful, and there's a lot of peace of mind around it, knowing that even though my personal cash flow could more than cover the debt service, I'm not worried about that at all. If I couldn't, then I would have never taken the loan in the first place, obviously. But there's just something really, really powerful when you have an asset that can pay for the loan service on another asset. It's just freaking awesome. Right, so it's just a matter of different goals, right? That's why everybody's different. There is no right or wrong way to do this necessarily. Is there an optimal way to do it? Well, yeah, the math would say that I should probably be reinvesting this stuff, reinvesting these dividends. But there's a psychological aspect to this investment game as well, right? So yeah, pure math says mathematically it makes more sense to reinvest back into BTCI, has a higher yield, just a stronger compounding capability. But see, I'm already doing that. I'm already reinvesting all of my BTCI distributions anyways. So I'm already getting that compound effect. Plus I'm getting the compounding still in my whole life policy, because I borrowed the life insurance company's money. I didn't use my own. So my cash value continues to compound. BTCI continues to compound. I have 2 assets that are compounding right now. So, mathematically I should probably reinvest it back into BTCI, but there's the psychological side of it too, the peace of mind, just knowing that I have another asset that's already paying for it, right? It's freaking awesome. All right, so yeah, asset pays for the other asset. Peace of mind. I love how it summarizes this at the bottom. Assets working for you versus you working to pay for them, right? That's kind of the psychological side of this. So my long-term plan is to continue storing capital for future financial obligations in Stretch. So I guess you could make an argument that at some point I will reinvest the dividends from Stretch. So for example, as I restore my capital base, I don't like having money in the bank. I usually keep like 1, maybe 2 months worth of expenses in the bank because we don't get any benefit from having our money in the bank. So as that capital base is restored, then, let's say I've got an extra $1,000, $2,000, $5,000, then I'm going to put that into Stretch. It just makes sense. It's better than sitting in the bank. So I guess you could make an argument that eventually down the line, I'll reinvest the dividends, but I'm just not doing it in a straight line, I guess. I'm using it to pay down the loan right now for the psychological aspect of it, of having an asset pay for the debt service of another asset. And as I build up my capital base again, when it's looking for a better home than the bank, then I'm going to deploy it back into STRC. So it could be an argument that I am at some point going to reinvest the dividends, but just not right now. I am going to be using it to pay down the loan service that I use to purchase BTCI. So that's what I'm doing. Anyways, really cool to see these dividends and distributions coming in, guys, and the different ways that we can strategically use those dividends to accelerate the wealth building process. These are just incredibly powerful financial products when you know what you're doing and you have a plan, an actual strategy that you can implement. So anyways, let me know what you guys think. Drop some comments down below. Love to hear your feedback. Hope you're crushing it, and I'll talk to you in the next one. To your success. Matty Ace is out.